All right, we are live with Stehphan Haynes over at Waterstone Mortgage. How you doing, Stephan?
Man, I'm doing great. How about yourself?
I am doing really well, man. Thanks so much for being on this video with me. I'm excited to talk to you. It's kind of rare to come across somebody with your skill sets, somebody who has over a decade in credit management, lengthy experience with risk design software. And man, every time I talk to you, I walk away from that conversation learning something or excited about credit. And so stoked that we kind of have the opportunity to chat today. I figure the best place for us to start is really talking about purchasing power. One part of our previous conversations has been, your pursuit of making sure that your realtor partners and your clients are set up in the best possible position so they can credit qualify. And that kind of falls into this category of, purchasing power, trying to make sure that clients know what their options are. So in your opinion, what does purchasing power mean?
Purchasing power is eliminating risk to get an approval. And how do you eliminate that risk? It comes in multiple different areas. It comes in structuring, money down, money sitting in bank accounts. But a big portion of that comes from the credit quality itself. What is their history? What kinds of credit have they had? Has it all been installment loans? Do they have revolving debt? All of these different areas, they come into play, and that's what puts your deal together. The stronger these areas are, the better of a loan that you're going to receive, the lower the rate you're going to receive. So, it's very important to really focus on those credit challenges in order to get the best deal.
I totally agree. And, one thing with purchasing power that I think a lot of people don't understand is, the better your credit score, potentially the more you can qualify for, right? Or the lower debt amounts that you have, the better that's going to impact your debt to income ratio. So, for you, if you've got a client who's sub 580, for example, what's kind of your process? What are you coaching them up on? What advice are you giving them to really maximize their purchasing power?
Well, first we have to find out why they're a sub 580. What went wrong at what point in their life, and what did they do to try to readjust and correct? Credit is Mount Everest to most people. They see the need in credit. They see they want a higher credit score, but they don't know how to climb Mount Everest. And in reality, all you got to do is drive on the road around it, and you're still going to get to the other side. So it's very intimidating to a lot of people.
Yeah.
And so one of the things that we do a credit analysis on every single client that comes in here, whether they are a 739 or whether they are a 479. The reason being is that 739 client, I had one the other day. All we had to do was pay $231 towards a credit card balance, and he went to a 750. All I needed him to do was get over that 740 hump, and it would save him almost a quarter of a point in interest.
On $230.
Yeah, $230. He did it sitting in my office, and this saved him thousands of dollars over the course of his term on $340,000 or $340,000. On that sub 580 guy, I'm going to look and see what kind of revolving debt does he have. Does he have credit cards? Does he have installment loans? What has he defaulted on to make it a 580? I've got a client right now who has pretty substantial medical collections. Medical collections, they do impact the score. However, they're kind of excluded on the underwriting process for mortgages. So in that regard, a company like you guys, I can collaborate with and say, look, I'm getting them a prepaid credit card. That's going to be their newest line of credit. In the meantime, we need to make one or two of these medical collections go away like right now. And in most cases, that's a 100-point increase pretty much instantly.
Yeah, and I think that for a lot of people who are in that sub 580 category who are looking to not only credit qualify but maximize their purchasing power, really understanding how to utilize revolving debt is a big ticket item. You know, a lot of people don't understand how that's going to impact their ability to qualify. And
Right.
then moving on to the low hanging fruit. That's one thing that I see all the time is we get clients that will come in and they'll say, "Oh, I've got this one account that if I resolve just this one account, and maybe it's like a $5,000 charge off from a divorce 5 years ago, and they think, oh, I'm just going to do this one account, it's going to boost my credit score, but yet they've got three medical collections and two cell phone collections, and you're looking at them going, well, that one big ticket item, yeah, that's important, but there's all this low hanging fruit over here that either has Fair Credit Reporting Act violations, or is easy to pay and resolve and potentially get deleted, right? Start with the things that are easy and let's work our way towards those more challenging accounts.
Well,
And
and not to cut you off, but who
no,
has
go
a
ahead.
$5,000 card? Him paying that off won't actually decrease his score.
Right?
What if it's already charged off and they're simply not reporting it? By them paying that off will make them re-report that and could impact his score 20 to 30 points negative.
Yeah, exactly. So we see a lot of times people will have this Mount Everest approach on credit, right? They want to tackle the biggest challenge on their credit, and they totally walk past all of these smaller items that could have a dramatic impact on the credit score. So I think that you kind of nailed it on the head there. Is just focusing on A, revolving accounts, and B, the low hanging fruit to easily get an increase in credit scores to maximize purchasing power and credit qualify. So
Right.
I think you nailed it on the head there for sure. Now, if we were to flip the script here and say, what are people doing that are negatively impacting their purchasing power? What do you see? You got somebody coming in, they want to buy a house, but what are they doing that's driving them down instead of driving them in the right direction? Because that's what I want to know. We see people all the time come in at that 640, 650, 660 range, but they're on the wrong trajectory. They're not making good decisions.
Right.
So what do you see there?
I would say high utilization on revolving debt
Yeah.
inquiries. You have to consider when you go to that car lot to buy that car just because your neighbor bought a new one, now you think you do. That car dealer, they're going to pull your credit. Then you've got the finance manager who's going to submit it to 15 different banks. Every time they submit that loan, or every time they submit that to that bank, that's a hit. And so, I think between high, and I would say good pay clients, their biggest downfall is utilization and inquiries.
Yeah. I'm so glad that you brought that up because inquiries are one of those things that I get phone calls on all the time, right? I get phone calls that say, hey, I can't figure out why, on a credit report, for example, you have the top 4 factors that are negatively impacting your credit score, which is, I hope you can agree with me on this because you're, and I hope you're okay with me calling you this, but kind of a credit nerd like I am.
Yeah.
It's absolutely ridiculous. There's over 200 different factors that go into a FICO algorithm, and they show you the top 4, right? They say, hey, these 4 things out of this entire world of these factors that are out there are hurting you. But then when you see inquiries, it populates as a 5th line item. So you have the top 4 things that are negatively impacting your credit score. And then when it comes to inquiries, it will say inquiries have negatively impacted the credit score. And that could impact your credit score by up to 10%, which is a huge hit. And people just don't understand that. So I get calls all the time that are, hey, how do I remove these inquiries from my credit? And the tough thing is, and a lot of people don't like that I tell them this, but if you dispute inquiries frivolously, right, it's, in my opinion, kind of a form of fraud. If you did go apply for that car, you did go apply for that credit card, it's hard to dispute those inquiries to try to get those removed because you did actually go through that process. And so inquiries are historically very difficult to get removed, and oftentimes we won't dispute them unless there's proof that there was some type of identity theft or problem or inaccuracy. And people just don't understand how big of an impact. I mean, 10% of your credit score, geez, that could be 85 points, right?
Well,
So it's a big deal.
yeah, it is a big deal. My stance on inquiries, however, in the risk models that the banks use to either approve you or turn you down, in my experience, there's not a set algorithm where it computes how many inquiries you have. It's more score driven. Those
Mm-hmm.
inquiries, I think, they weigh down the score, and it doesn't give a good example of that particular person's credit management. And so, I think that is one of the biggest things that needs to be changed in credit and risk models, in my opinion.
Oh man, I could not agree more with you. Credit is becoming more accessible, and your credit report is being pulled for more things than ever before.
Mm-hmm.
And like owning a business, for example, my credit gets pulled all the time.
Right.
And so I'm in that category. But one thing that's interesting is you bringing up the fact that I do think a lot of banks or lenders don't have limitations on how many inquiries you can have. It really, like you said, is score driven. And we'll leave that for somebody else to talk about whether or not that's fair. But that's really intriguing to me. I very much agree with you that needs to be a big change. So that's a good point. Now, one thing that I've been kind of dying to ask you about is you brought up that you've kind of worked, and I can't remember exactly what it was, but you reverse engineered a scoring model at one point. Tell me, if you were to build your own scoring model, right? If you were to build your own scoring model that you thought was fair, would you weigh more on payment history? Would you weigh more on revolving debt? I mean, what would be kind of some? And I'm throwing this at you out of left field, so I'm sorry. But what would you kind of build that off of?
We actually, in the previous company that I owned, we were a software development company who had a risk model. So I have built my own. And how we did that was pretty interesting. It was primarily aimed to car dealers who wanted to manage an in-house portfolio. So instead of selling their loans off to these other banks, they could just keep those type of deals in-house.
Oh, that's
And
cool.
the risk model that we built, I would have a conversation with that dealer principal to find out how much risk he wanted to put on the street. And so, one of the things that I looked at and weighed extremely heavily on really had to do with the collectability of the loan. And even in the event of a default. Now, keep in mind, this is primarily aimed towards car finance and not home finance, but collectability of a loan, if you've got an individual that has nothing but derogatory, but he has 10 years at the same job, 10 years renting from the same place, what is the likelihood that that person is going to change just that one routine of their life? Mm-hmm. So even in the event of a default, we will be able to find that vehicle. It's either going to be at his job or at the house.
Yeah.
And so that collectability part, it really all lands in the profit margin that that particular lender wants to have. Being able to pinpoint where someone will be really reduces risk. So take that 479 credit score individual that has had 6 jobs in 4 months and is staying on a couch over here. That guy, collectability is extremely difficult. It's hard to peg where that individual is going to be. So therefore, structure and collectability are the two things that we built that or tailored that risk model around. We weren't really as score driven as what a lot of institutions are. We took more of a common sense approach to
it. And don't you think that that's kind of where we need to go a little bit in the scoring world? We need to do another video where we talk just about that, because I did a podcast recently on artificial intelligence and credit scoring and how it's becoming more of a problem than it is a benefit. there's this thing that they call explainability, where these artificial intelligence platforms for credit scoring eventually evolve to a point where you can't explain the factors or identify the biases that are being calculated on a consumer. And that's a huge issue, right? I mean, it's like we're going too deep into the abyss instead of trying to pull out of it, in my opinion. So I think that needs to be another video that we need to do. That would be a fun conversation. But I got to tell you, it's been a really enjoyable conversation on this. Purchasing power is one of those things that I think people overlook. People are often too score driven, in my opinion. People think, oh, I just need to be to a 620. But if they understood purchasing power, if they understood the combination of debt management and credit score and how to manage all that, they'd be in a much better position. So thank you. That was a really good kind of point to bring up. But I got to plug you at this point. I got to tell you, one of our regional managers, Harry, put us in contact, and over the last couple of weeks, we've had a lot of really fun conversations. And Harry obviously speaks the world of you. But before we get off, man, is there anything that you want to plug for Waterstone or about your team?
Man, we try to have that common sense approach. When it boils down to buying power, the biggest thing is the individual that pulls the credit. If I can look over someone's credit and they have all of these great areas, I can, for the most part, talk our way into a good situation for them and help them out, get them from point A to point B. So in reality, we do our best to try to turn people away from us looking at them as a number and looking at them as a person. And how can we help that person get the American dream, their own home?
Yeah.
And so, with the right counsel, the right guidance, this is the judgment-free zone. And so when they come in here, I want them to be comfortable. I don't want people to feel like I am judging them or looking down on them because of some mistakes that they've made in the past. Let's get it corrected. Let's move forward. Things happen, but all we can do is pick up the pieces and show them how to get them corrected.
I love it, man. That's a big deal. That fits a lot of why we do what we do here at Premier Credit, and I'm excited about your guys' approach. So obviously, if you guys have any questions on credit that are watching this, please don't hesitate to reach out to us with any credit questions. If you have questions about a mortgage, please reach out to Stephan and his team over at Waterstone. They are fantastic. Stephan, thank you so much for taking time out of your busy day. We're going to sign off, but we got to make sure that we do another video on those credit scoring topics.
Thanks, Alex.
Awesome, man. You have a good day.
See you, bud.